Good day, all. Ira Epstein of Linn Associates with your weekend edition of your agriculture wrap-up, and this is for Friday, the 23rd of August, 2019. Now, the time as I'm doing this is just after 3:30 p.m. They just reopened stock indices. They had come smashing off their lows about 200 points in the last minute of trading, but as you can see, a down day in the stock market. We saw the Fed Chair Powell speak today. We saw the president react to what he said. We saw then the president order American companies out of China, which he doesn't have the authority to do, by the way. He can do other things, but that's not what he did. Then we had the pro-farmer tour wrap up in the cattle on feed. So before I get too far, let's go to that. The cattle on feed report came in as of August 1st with 100% cattle on feed. The estimate was a little larger, 101, so that number's a little friendly. Placements, not as many put in, 98% versus the placements of 100%, and the marketings were much higher at 107 versus the 106. Now, not much higher than the estimate, but way higher than the prior month. So overall, that report should be neutral to friendly at the very least. On Friday, we saw, which is today, as I'm recording, the crop scouts for pro-farmer pegged, and let me step back here so you can see this. The average 2019 corn yields way under the USDA at 163.3. The USDA was 169.5. That would give you, if you take a look at it, their total production according to pro-farmer, just an estimate of 13,358 versus the USDA forecast of 13,901. So that number, I think it was in the trade to a degree, but it's certainly not bearish. When you look at the tour of the U.S. bean yields, they came in at 46.1. The USDA was thinking 48.5. They're looking at 3.497 billion bushels compared to the USDA of 3.68. So we have a set of numbers from pro-farmer compared to the USDA that are basically friendly. How much of that's in the market? Don't know. We saw wheat get a great bounce today. Wheat acts like a market right here that something else happened to it today because corn was weak and the beans were weak. Now remember what we do in this weekend edition. We look at one chart of monthly and then everything else is going to be weekly charts. So let's go and take a look first at soybeans on a monthly basis. The one thing that's glaring is since 2018, going back into about the middle of it, once the market peaked out over 10, it's really never been able to get back up and close over that. Number two, it's staying under the 18-month moving average, which is 8.99. And for the month, we have one more week to go. We're down roughly 21 cents for the month. When we come to the weekly bar chart, each bar here represents the high and low of each week. When you look at the bar, you can see the market's been coming down, and the pattern has been one of actually lower highs, lower lows. Therefore, this market's in a bear phase. Until the market takes out the last rally high on the swing line of 872, the trend remains what? To the downside. Where are the key moving averages? The 18-week moving average of closes is right here. This comes in at the 864 level, and you'll notice that once you slid down under it, you didn't even stop at it the first time. You came back, you fought a battle at it, and you're coming back down. Now, what the trade will be looking at that watches charts, they're going to look to see, can you take out the 837.25 area before the market takes out 872? Should it take out 872, a lot of traders would say, the market's starting to put in a pattern, higher lows, higher highs. What do the bears have to do? They have to defend their position at that 864 level and try to stop that from happening. In terms of Bollinger Bands, which are an algorithm designed to keep the market within them 95% of the time, they're pretty far away from the market on either side. They're down to 802 and up to the 925 level, so I don't think they're in play. As I'm defining the chart right here, I see the swing line down. Because the market's under the 18-week average of closes, the bias is down, and when I look at momentum, it is still pointing down. So all parts in this market are still in a bearish phase. In the meal market, when you go to this chart, you see the lower highs, you see the lower lows. Momentum is pointing down. Now, on weekly charts, I don't look to see as a market overbought, oversold, or embedded as I do on the daily charts. They're either pointing up, pointing down, or going sideways. In this case, momentum's down. The bias is down since the market's under the 18-week average, and the trend is down because you have lower highs, lower lows. What breaks that pattern is getting over last week's high of, what was that, 298.30. So until that's taken out, you do have in play the possibility of getting down to the 281.20 level, the lower Bollinger Band. I'm going to repeat what I often say. The first challenge of Bollinger Bands, especially when they're wider apart like this, unlike back in this narrow area, often is an area where some money comes off the market. If one's short, that could be an area they do it. I am not telling you do it or don't. I'm just telling you what I notice. In soybean oil, you have the daily chart looking more bearish than the weekly chart. On the weekly chart, we still have this pattern of higher lows, higher highs. Now, the flip-flop of what I just said in the meal market. The first challenge of an upper or lower Bollinger Band is often where the market runs into, be it resistance or some support. The market went up last week, hit that number, and this week you're into a corrective mode, but you're still in an uptrend. Support comes in at 27.85, but you have divergence. You've got momentum pointing down, the bias up because you're over the 18-week average, and the swing line up. In the corn market, you're in a downtrend. Lower highs, lower lows. You are under both the 18-week and the 100-week average, putting in the play that if the market continues to the downside, 336 3/4, the lower Bollinger Band could easily be a support zone. Now, what if the market comes up a little bit? Well, the first resistance would be the 100-week average. The second would be the 18-week. In order to turn the trend at this point and neutralize it, you can't turn it up with this pattern, by the way. If the market were to soar over 412, you'd end up with a pattern of a higher high and a lower low. What are the bears looking at? Probably resistance at the 100 and the 18-week average of closes. In the wheat market, while the dailies had a reversal, you haven't done that on the weeklies. You're still very much with lower highs, lower lows, two layers of resistance facing this market. The 100-day average, which is 483 1/4, let's call it, to the 18-week average of 490 1/4. You'd have to get over 502 3/4 on the weekly chart to negate the downtrend, and on this particular pattern, even if it did it next week, you could not end up in an uptrend. All you could do is negate the downtrend because you'd end up with a lower low and a higher high. This trend on the longer term is bearish, not the dailies though. In the cocoa market, not surprised to see the market try to give us a bounce. The settlement was 22.08 over the lower Bollinger Band. Be it a weekly chart, daily chart, markets typically trade 95% of the time within these bands. When you get out of them, it's generally for a very limited period of time. And I have a way that I teach in my charting course of counting each successive period outside of that band, and I start taking percentages from the 5% of the time it trades out of it. Like coming into this week, I had a 97% probability the market would climb back into the band. That doesn't mean you're changing the trend. It just means you're out of the band. You might be able to get into this market better if one is still in the bear camp. The chart, lower highs, lower lows, still bearish, but you've hit a downside target. Momentum is flattening out. This market's got two resistance points. The first one is the 100-week at 22.81, then the 18-week at 23.86, but you have hit a downside number. In the sugar market, still in a downtrend, and you can see how the 100-week average was offering the resistance all the way here. The market's in the downtrend because you have the lower highs, the lower lows, momentum down, still in a downtrend. You've hit the lower Bollinger Band, bounced away each time, didn't quite get up this week to the 18-week average. Support would be at 1174. Now let's assume the market doesn't take out 1127 and it got over right through here, 1196, and closed over that. My guess is that the 12-cent level in the sugar is going to represent, it's going to be lower than that next week. And the reason is you're dropping about 5 to 6 points each week. That's going to be an important number. I'm not saying it's going to hit it. First support's 1124. In the cotton market, I hate when you get these type of reaction to the market. They're very difficult to trade because of it. If you look, all you've had are lower lows. You haven't even had a higher high week. And this is a weekly chart. That's over a 2-month period. So it just ground itself down. It went through a prior low. You've got a pattern of a higher high, a lower low, and a market that's got two things. It's got downside bias and momentum still pointing down. In the cotton market, lower highs, lower lows. Agreed? So you have a market here that's in a downtrend. Momentum, though, is flattening out a little bit. So there's a bit of a caution sign. Should the market get over 60.12, I think the bears would negate their bearishness because you then could end up with higher lows, higher highs. That would not be the beginning of an uptrend because you're not over the 18-week average. But it would be enough to signal that this decline may have run its course for the time being. Let's assume you don't take out that 60.12. You still have in play then the possibility of 54.91, the lower Bollinger Band. In the cattle market, I had warned all week long in the daily, you've got to be careful here because the algorithms come in these markets. And what you had today was a lot of people coming out in front of the cattle on feed. Now, we saw nothing but bearishness in world trade. I would say that if you looked at the president's tweets, he called the President Xi an enemy. He called our Federal Reserve chair an enemy. And that is not how you're going to make a trade deal. Do you disagree? And the cattle market plunged. And for the week, you were up 4.7. But if you looked at the daily chart, you gave back a chunk of that. I think you were a limit down in some of these. In the hogs, right back down into the toilet, if you will. And the reason, you really think China's going to buy any pork from us? What they'll buy is what they can't get anywhere else. That's what they'll buy. So when you see that we're doing export business and soybeans to them, it's because they can't get the beans anywhere else. They hate buying from America right now. We're in a trade war, a full-blown trade war. For the first time, the enemy word coming out. Not healthy. Down into support at the lower Bollinger Band. So you put it all together, you try to come up with game plans, and that's what I do. And if you're like me, you probably question what you're doing in these markets. I do, and I do it all the time. You know, I've been at this 50 years. I became a registered broker in 1969. Hard to believe. And back then, folks, it was so different. But the difference was, and the advantage was, I can go from office to office. We didn't have all this computerized stuff. You'd have to talk to people, which is an unusual skill. The second thing is everybody wanted to teach everybody else. And you learned charting. So I take what I learned over the years, and first thing in the morning, what I do is I record a video. I typically start recording between 5:30 a.m. and 6. I've already read what's going on in Asia, Europe, and I have an idea of what we're walking into in America in terms of major reports. So I typically review 40 futures markets and 5 ETFs. The idea here is to give you ideas on, first of all, fundamentals, technical analysis, and unlike these videos, I'm going to say buy here, sell there. It's a lot of charts, agreed? So on the bottom of the charts, what I do is I put a slide bar. You can go to any section you want, and it lights right up and says you're in the grain section, you're in the meat section, whatever part you want. I record in this sequence all the time, but as I said, there's a slide bar. You pull it, it'll light up and say meats, grains, softs, just let it go. It'll play, plus there'll be a lexicon right on the side here you can click. So the idea here, yes, I'm going to review all the markets at one time. I'm not going to make separate videos for the financials versus the grains or the meats. Why do that? You can do it easier this way. There is a cost to it. 26.5 cents a day to give it a try. If you like it, you have two choices after that. You can either stay with it, and that becomes $15 every 30 days, or $156 if you want to buy a year ahead of time. A lot of people do that, by the way. So think about it. At 26.5 cents a day, you got a question about the market, and you say to yourself, what's he thinking about it? If you're watching these videos, you're watching them for a reason. Why not see what I can really offer? With that, I'm Ira Epstein. Hope you take advantage of this, and I will talk to you all come Monday. Take care now.